All the normal investor, whoever is investor, is more worried about.
I want to debunk that notion. I think you would not have heard this argument too often in the market. If you are investing in, you are going to something where 100% of the time you're going to underperform.
Do you really think
All of them have underperformed their respective benchmarks.
Okay, so you say that in a longer run, fund?
I can't make a statement that
Yeah,
will
but-
always,
but
but if
yes.
you look,
Harsha, thank you for being with us with Money Tree Partners on the show. A very important question these days, active versus passive, All the HNIs, all the normal investor, whoever is investing in the capital market is more worried about the expense part, the TER part. And the way you get so many Instagram videos about, invest into index funds. It is expense free and, you'll get better returns in an index fund. Do you really think an index fund would be much better in terms of investing over on the way forward? Or do you think that active funds still have a way to go?
first of all, I think these two categories are not mutually exclusive. That's what most people get confused with. It's not one versus the other. It's just a preference, which vehicle or which route you want to take. And also this part that index funds don't underperform and have less cost. I want to debunk that notion. I think you would not have heard this argument too often in the market. If you're investing in a passive fund, whether it's an ETF or an index fund, it's always going to give you underperformance because there is a commercial that is involved. Index funds also have a cost. ETFs also have a cost. Smaller cost than active, but there is a cost. There are other issues in terms of tracking the benchmark. And you look across ETFs and index funds in the country, all of them have underperformed their respective benchmarks across time periods. Okay. So if you are just looking at cost, yes, it's the lowest cost compared to active funds, but you will also get 100% guaranteed underperformance. And that underperformance is also not very large, but there will be an underperformance always. You will never get outperformance from passive funds, whether it is ETF or index. If your basic issue with active funds is they are likely to underperform and hence you are going to passives, then you are going to something where 100% of the time you're going to underperform. In actives, yes, the cost is little higher, but at least you are keeping that window for outperformance open. Not all funds outperform. Not every fund, every phase of the market will outperform. But if you're a long-term investor, most of the funds in the mutual fund category have managed outperformance against their respective benchmarks. So it's a choice. Whether you are okay with a small guaranteed underperformance and a lower cost, or you are willing to pay slightly higher cost and keep that outperformance window open, is a choice that you need to make.
Okay, so you say that in a longer run, an active fund will always outperform a passive fund.
I can't make a statement that
Yeah,
will
but-
always,
but
but if
yes,
you look at history,
look at
they
the
have
history.
most of them have been delivering that outperformance.
Thank you so much. It
Thank
was
you.
such a breather for us because these days investors have really been pestering and asking about this, that why are you investing into an active fund where I have to pay a higher cost, and why not a passive fund? Why not an ETF? Thank you so much, Harsha.